Hello everyone, welcome to Just Invest Today. And today we are talking about Alibaba stock. We're talking about Charlie Munger. This guy wrote an article saying that Charlie Munger already made a mistake. The Alibaba investment is dead. There's no good. So we're gonna get into it in this video. But let's look at the article first. Guys, can you please like this video, subscribe to my channel, click it down below right now, man, please and thank you. Can you please help me get to 1,000 subscribers? I greatly appreciate it. Thank you. This is a Seeking Alpha article. Charlie Munger is wrong again. So this guy came out, he said Charlie Munger is wrong again. Remember, Charlie bought this at like 210, probably around 190. So it's only at $134. This stock has like a forward PE of less than 10. You just have to think about that. This is one of the most dominant companies in freaking China. Like, it's the most dominant companies. It's Tencent and Alibaba. Just imagine a company like Amazon, like Google, selling for a PE of a forward PE less than 2, 3. Can you imagine that? Like, that's what's happening in the market today. That's the opportunity that the market is giving you. And you gotta think about this too. China is growing faster than US. They're growing at like 6%, 7%. US is only growing at like 3, 4 maybe. Maybe a little even lower than that. So if you just take that all in, as the economy grows and the China market grows, Alibaba has to grow because it's that dominant. It's the number one e-commerce player. So no matter what you think of it, the number one company in China or the number two company in China shouldn't be this cheap. It's almost like impossible to think of. And it probably will get even cheaper, which is actually insane when you really think about it. So let's get into this article and let's see if we can counter his thinking. If he's right about this, he might be right. Who knows? So tell me what you guys think of this. Is he right? Is he wrong? We're going to go through some of the articles, the main points, and see what you think, what I think, and if he's right. So Alibaba's disappointing performance in Q2 along with its weak guidance for the rest of the year signals that nothing continues to be certain with Chinese stocks. This is like, what company doesn't go through a weaker guidance? Maybe they go through poor performance. Amazon just had a decrease its revenue, decrease its earnings per share. Amazon just went through this. No one's talking about Amazon being a bad company. We don't know where the US market's gonna go. You know how many companies have like fell in like more than 50% this year? Like, are you saying all those companies are dead? Are you saying all these companies are dead? They all didn't meet their expectations or their guidance or whatever made up Wall Street jargon they spit at you. Like, who makes up these guidances and all that garbage? Like, companies are gonna go all over the place. You can't just always beat earnings or always beat revenue. Like, no company runs like that. That's not even realistic. One company, it just always goes up in a straight line. Companies go up and down, sideways, turning. Like you can't expect companies to always meet metrics. Like, it doesn't always happen for every single company. It's almost impossible. Not even Amazon can do it. Google hasn't done it all throughout its history. Like, Facebook hasn't done it all throughout its history. Meet guidance estimates, like all the garbage. Look at this. So you're saying all these companies are dead now because they didn't meet guidance or their revenue went down or they have like a weaker guidance going forward? Twitter, PayPal, Snap, Chewy, Lyft, Palantir, DraftKings, Pinterest, Ruko, Bumble, Page, Wix, Baidu, Alibaba, Zoom, Robinhood, Beyond Meat, Lemonade, Zillow, Stitch Fix, Tencent Music. You're saying every single company is just garbage. It's because there's a weaker guidance or whatever. There's some companies that went up and they had a weaker guidance going forward or the revenue didn't miss and they're still going up. What does that say? What does that mean? See what I'm trying to say? So how much does that matter, really? Even after paying a record fine of $2.8 billion, making peace with the regulators, Alibaba still struggles to convince the market that its downside is finally priced in. That's true. It's honestly like it's like a falling knife at this point. So it's hard to gather where you should buy. I think that's my one mistake is I kept buying even with like a 10, not even like a 5% drop, 10% drop, because I thought it wasn't gonna go any lower. I should have waited longer for the drop. I bought it at 142, but like I should have waited longer to get like cheaper prices. That was my one mistake. Catching the falling knife way too early because my cost basis is around 200, 210. I could have got a cost basis around like what? Like probably like 180, 70 because I already have a 20% position. I'm not going to put any more than 20%. That's a really huge position in my portfolio. So I can't go any lower. I'm not allocating any more money. It's safe to assume that's not all. The political risk has materialized to this day since Beijing continues to be involved in Alibaba affairs to this day and will likely continue to strengthen its grip over the rest of the Chinese tech sector. See, this is my thing. No one complains when like Google goes under investigation. Facebook just got fined and they're going under investigation for like hurting teens, and Google just got fined for monopoly practices. Apple for having that stock hold on the market on the apps, like, and then Epic Games are going back and forth. Like, all of these, every single big company goes through this, and you got to think about like this: China never had regulation, so they're now getting attuned to regulation. China, Xi Jinping, they all came out and said that they're not trying to harm these companies. They said that, like, they fully on said that they're not trying to destroy these companies, hurt these companies. Like, one of his like lower superiors said that. They said they're just trying to put in regulation like every other country. So why do people keep saying that like Alibaba is just gonna get nationalized? Like, when has China just ever nationalized a company just for random, just for fun? Like, is there like a point in history where China did that? Or you're just saying it's gonna happen now because whatever. So the stock is down 13%. The company failed to beat earnings estimates second quarter in a row. See, this is my interesting thing. Like, just because you didn't beat earnings, it doesn't matter. Alibaba's core business, which is part of the customer management segment, and includes profits that are generated through the fees and marketplaces Tmall, Taobao, along with ad revenue, has increased only 3%. This is true. This was an interesting fact. I mentioned it in my other videos that I might be concerned with this customer management segment because that's how they generate a lot of their revenue, their earnings. But they're saying that the demand like wasn't there yet because the economy is kind of going down, and Alibaba basically makes up like 40% of their economy because that's where the e-commerce goes in and out. The cash flows of the basically China goes in and out. So if the economy is not doing as good, Alibaba will be affected. And there's competition, so that's what I'm worried about. Is it more competition? Is it more the economy, or is just Alibaba just investing in more businesses? We're gonna find out later on. So during the quarter, Alibaba's EPS was 1.74 per share, below the estimates of 1.86. Who cares? Non-GAAP revenue income 39% to 4.4 billion. So this is key. Like, this is key right here. After falling under grace with Beijing, Alibaba no longer has a status of a key software enterprise, which is giving it the ability to pay income taxes at a reduced rate of 10% going forward. Alibaba's effective tax rate will be 25%, and it already had a negative income on its income statement this quarter. So yeah, so that's gonna harm Alibaba, yeah, going forward. But think about it like this: like, that's a normal tax rate in the U.S., Europe. I think Europe's even probably more expensive. Like, and they're even in the U.S., like in Canada, they want to raise taxes on corporations. So this is nothing new. Like, this is nothing new. Like, people get tax breaks. Remember, these tax breaks was just because China was in the growing phase of the economy. So now they're trying to have everyone settle down, and you don't have to use those same steps to get your economy going because Alibaba's already established company. So you don't need those huge tax breaks, even though it'd be amazing. But yeah, if you really think about it, that's a normal tax rate. So it's nothing crazy out of the ordinary. Because yes, Baba had that advantage of not having to pay that much taxes. So maybe, wow, the earnings go down a little bit. Who cares? Like, is the business still doing well? Like, is that gonna affect the business? That's what we want to know. Is these metrics, guidance, whatever, affecting the overall business. And remember, this guy's point of view is that Charlie Munger is wrong, right? So it hasn't even been a year yet, and he's saying Charlie Munger is a wrong investment. And that's the thing. The market can go up and down whenever. Like, who knows what's going to happen in a year? That's not what... All sentiment in a year, all of it is sentiment. Over 5 to 10 years, all of it is actually business growth and what the business is doing. That's what you guys got to realize too. So considering this, is safe to say that Alibaba is unlikely to significantly improve its bottom line performance in the following quarters, especially since the growth of its business is expected to slow down as well. So this is it. If earlier Alibaba was aiming for 30% growth, the business is only growing at 20% to 23%, and that's what they guided now. So 20%, 23%. Think about this. A $400 billion company growing at 20%, 23%. Is that bad? Like, when you really think about it, a $400 billion company growing at 20 to 23% revenue growth, that is good. Some smaller companies don't even grow that fast and generating that much income. So when you really think about it, it isn't that bad. Like, the company is still growing fast, and they're not even like accounting for like the business of Ant and the business of the cloud computing. As that gets bigger, that's going to contribute so much to the freaking revenue. So people are not even taking that into consideration, how that's going to be the main factor. Like, think about Amazon. And we're in the early stages of the cloud business with Baba. So think about it. As Amazon got bigger, as AWS got bigger, it's taking up more portion of that revenue stream, and it's becoming more profitable, and the margins are getting bigger. That Alibaba hasn't even reached there. It's like 3%, 4% of the cloud market. So think about that. So they're saying the Chinese economy weakened. China's GDP increased by 7.9% year over year. Then the quarter three, and the growth still only 4.9% in 2022. It's expected to grow only 5.2%, but below the initial forecast of 5.6%. However, there's still a risk that China could grow even less than 5.2% next year, since all the downside from the fall off of Evergrande hasn't materialized yet. So yeah, the Evergrande situation hasn't come to fruition. Remember, this is the situation with the real estate company might go bankrupt, and that doesn't really matter because that has no effect on Alibaba's business, really. Like, if you think about it, like, Alibaba is separate from China's Evergrande business, so it doesn't matter. Even if real estate explodes, what does that mean? Alibaba is going to go away? It's not going to be a viable company anymore? How does that make sense? So that doesn't even matter. Say Evergrande goes bankrupt, how does that affect Alibaba? Like, people are still going to use e-commerce, still going to buy products. Like, they're still going to go on Taobao and Tmall to advertise their products. So that doesn't even matter if you, in the grand scheme of things, 5 years down the road. Don't underestimate the Chinese Communist Party. So Beijing continues to slowly but surely centralize its power within the nation by strengthening its grip across a lot of different industries at the same time. Alibaba was one of the first targets last year due to the size of more than 60%. Look at this. As more than 60% of the country's population uses some of the company's products or services. So these are the people saying that he is wrong. 60% of the country uses freaking Baba, and he's gonna say this company is a bad investment. Charlie got it wrong. Can you imagine someone saying Google? Everyone uses Google, like 90-80% of the population, and they're saying, oh, that's bad because maybe there's some kind of regulation or there's some kind of threat to Google, but that's all short term. That's all short term. You got to think about this, right? That's short term. The Ant Group situation, they actually did that for a reason. It wasn't just out of the blue, no reason for it, right? And then now they talk about common prosperity. And when you actually look at the document with common prosperity, these are just initiatives to help smaller businesses. The stuff that Alibaba already does. Help smaller businesses, invest in medium-sized businesses, help merchants. It's common prosperity is literally just helping the public get more access to wealth, which is actually getting them to invest in small businesses and medium-sized businesses. Exactly what Alibaba does. So common prosperity is not really donating to the government. It's just helping the people generate income from their businesses. So That's what Alibaba really does. So common prosperity is whatever. What's worse is that even if the investors purchase Alibaba shares on the US or Hong Kong exchange, they still don't have a share in Alibaba's underlying business. Since it's prohibited for the non-Chinese citizens to own the company share under Chinese law, this is where you guys gets it wrong. Even if you invest in Hong Kong, even people in Hong Kong are not getting the actual company. So he has this VIE structure just wrong. Like everyone can't own it. No one can own it. You even if you're a Chinese citizen, you don't own the company. So you're saying that they're gonna stop the VIE structure and screw over their own citizens? Do you believe that? Like honestly, they're gonna screw over their own citizens because the VIE structure is everyone. It's not just freaking Americans, Canadians, Europeans. It's literally everyone. So they're screwing up. If they stop and ban the VIE, they're screwing up their own country, right? So that doesn't make sense. If you're worried about a USA ban, okay, maybe that's a possibility. Maybe USA bans it, or he says that they're just gonna Beijing or China is just gonna ban just US from owning it. But why would they do that? That makes no sense. They open up a new stock exchange, Beijing stock exchange, and they're allowing foreign investment. Why would they just open up a new exchange and then allow foreign investment if that was their goal? Why is Xi Jinping talking to Biden and saying that Biden's a good friend? We want to get communication good. Why is he all doing that? Is he just grandstanding? Like, or he just really hates the Americans? I doubt that's the case. If Xi Jinping is going out of his way to communicate with Biden, and he said he's going to release the oil reserves with Biden, like, why would there be communication, negotiations? Why would they be doing that if they just want to stop all Americans from investing in the company? So that makes no sense. So the whole VIE structure, like, it just doesn't equal up because if they ban it, they're killing the Chinese people investing in Alibaba as well. So, yeah, it just doesn't make sense. Nothing stops it from doing the same to VIE structure to get control over those companies that access the U.S. capital markets in the past. Yeah, they've never just killed any company. So, just doesn't make sense. So, what he's saying about Charlie Munger being wrong on this investment, that's not you have to look over a 4-year span, 5-year span. You can't just say he's wrong in a year. In a year, the market goes up and down. It's an auction driven market. No one knows where the market's going to go in a year. There could be a crash in the next 10 days. Are you going to say, oh, Facebook or Google is a bad company because it went down 40% because there was a crash? No, you wouldn't say that. So it doesn't make any sense. So the bottom line is that it's bad. Alibaba has solid stock to own if you're a Chinese national. See, it doesn't make any sense because that just doesn't make sense. Think about it. Even if you're a Chinese national, you're still investing in a VIE, no matter how undervalued. So he knows it's undervalued. See, he even knows it, but he's worried about the VIE structure. The VIE structure is a risk. Like, you can't discount it. Like, there's so many possibilities. Because think about it, stocks, you just don't know what's going to happen in the future. Like, anything can happen. So you can't just say, oh, because it's never happened in the past, that means it can't happen in the future. I'm not saying that, but the chances are diminished. Like, the chances of it happening are diminished since it's never happened in the past, and it goes against what the government has been saying. The government says they want foreign investments. They've been preaching this since the whole Alibaba debacle. They've been saying, no, we are not trying to kill the companies. We're just trying to make it safer for everyone to actually invest in these companies. That's what the laws are doing. So other than that, they're not safe, blah, blah, blah. Western peers are frozen to place. Alibaba will likely continue to trade at current distress levels for a while since the involvement of Beijing in the company's affairs, along with the expected slowdown in the Chinese economy, will prevent institutional investors from repurchasing shares even at the current levels. See, that's the risk. The institutional investors are just running out of the stock. That's what's causing all the downturn. All the institutions are just running out. But guess what? That provides the opportunity. That means that the stock goes to its rightful shareholders, us, the long-term investors. Institutions have the institutional imperative. Like, they have to go out of these companies that are going down. They have to go out of it. They can't take 30-40% down years, losses. Because you know people are going to be knocking on the door being like, oh, you were bad, you didn't succeed, you took a 40% loss on these Chinese companies that you didn't know anything about. So yeah, they're going to run out of it. But we don't have anyone talking to us, clamoring about our stock returns. We don't have that. So we can take a 40% hit and wait 2 years to maybe it doubles. If it doubles in 3 years, that's still 23-24%. So we can wait 3 years for a stock to double, and we can still make 23%. And that's a good return when you think about it. Think about that. It can double in 3 years and you still make a good return. Do you think it's going to take 3 years for Alibaba to get back to where it's at? I doubt it. So tell me what you think about this video. Am I right? Am I wrong about this? Is this guy right about this? Maybe I'm just biased because I own Alibaba, right? Who knows? I could be biased, right? So leave a like, subscribe to the channel, man, and I'll get back to you in the next video. Peace!